day trading or dividend investing? Which one's better and which one's worse? And which investing strategy should you choose? Hey guys, welcome back to another video. Once again, we are putting day trading up against dividend investing, but we're also going to talk about swing trading. So basically, this is a three-way deadlock. If you guys want to see more of these types of videos and you're new to the channel, please hit that subscribe button, leave a like on the video, and comment any thoughts or feedback in the comment section down below. I have some great news, guys. We got our first 2 free stocks from people using the referral code on one of my videos. Now you're going to see right here, it is from, if we click it, you see we got Ford, and I accidentally opened it off camera, but there's a second one that I'll be opening right now. So thank you, Reen, for using the link in one of my videos, and I did get Ford, and Ford is a dividend stock, and I was a little skeptical of getting it, but since I have it now for free, I might as well keep it. So I'm gonna keep it and hold it because it does pay out dividends. I'm not gonna sell it and reinvest it into a dividend stock. And you can see the rest are just from friends and family from last year. So now let's open the second one from Mark. Thank you, Mark. Let's claim this free stock. Now the first time I scratched the one on the right, so this time I'm gonna go with the one in the middle. Come on, I'm hoping for something great. Scratch it off. Plug Power. Okay, I've never heard of that one, but it is $3.84. Yeah, I've never heard of that stock, but this is a great feeling, guys. This shows that new people who are new to investing in Robinhood are checking out my tutorial video, which was our second most recent video, and that's just a great feeling. Show that like what I'm doing can help educate people and help them change their lives. And speaking of people who are new to investing or trading stocks, let's see which strategy of the 3 is the best for you. Let's start with the dividend investing. Now, what on earth are dividends? Well, dividends are basically money that a company that you're investing in pays out to all of the shareholders. You're a shareholder, I'm a shareholder. If you bought a stock, you're considered a part of that company and you own a tiny percentage of the company. So since you've decided to take this sum of money and buy the stock because you have faith in the company, as a result, these dividend paying companies have decided, you know what, as a reimbursement, we're going to take a small percentage of our stock price. We're going to pay it to you, whether it's monthly, quarterly, 2 times a year or semi-annually, or once a year annually, because it's just this extra surplus. Now, the opposite of a dividend stock are the growth stocks. These stocks are stocks that don't pay dividends. Instead of taking the extra money that they have from revenue, they take this money and they reinvest it into their business or company to create more innovative technology or services. Kind of like Tesla, they take their revenue, they reinvest it, create all of these better cars, electric cars for the future, working on SpaceX, working on all of these other projects that Elon Musk has in store for Tesla. Now, dividend investing is a very passive way of making money because all you're doing is investing in the stock and then you just wait to get paid your dividend. And that's really all there is to it. And since you are holding these stocks for a very long time, if you hold them for up to a year plus, they count as long-term capital gains. Long-term capital gains are taxed less than short-term capital gains. So if you were to buy a stock and sell it and take the profits within the year, then you are going to be taxed at a higher rate on the profit that you earned. Now, it is no surprise that dividend investing is a very slow and gradual way to grow out your portfolio. So that might be a turnoff for some people because most of the time the percentage yield of all of the dividends from your portfolio combined is only up to like 4%. But there was a study conducted a while back called the Trinity study, or the 4% rule, which stipulates that a person has enough savings in assets if 4% of their portfolio or assets are enough to cover a year's expenses. So a goal that many dividend investors have are to live off of their dividend payments up until retirement and going way past that. So if you can take 4% of your portfolio and that can cover a year's worth of expenses. You're wealthy, you're financially free, you don't have to work anymore. But yes, the main shortcoming is that it's a slow and steady process. But if you are in a position where you can aggressively invest in the portfolio, or you just have a large sum of money just sitting around and you can reinvest it into the stock market in dividend stocks, then you might be able to cut that time down by a large amount. Now, what's the difference between trading and investing? Well, we already covered investing, but trading is taking advantage of the price fluctuations of a stock price. You're not really becoming a part of that company because you're only holding that stock short term in the hopes of gaining a short term profit. So let's just talk about a random stock. There was this stock that I used to look at when I used to be a day trader, and it was JD. I have no idea what JD is about. I didn't care about the news or their financials. I just cared about making a profit on JD. So I could buy maybe 10 shares of JD at 9 a.m. when the stock's open. And then if I gain maybe like a 5% profit on JD, I would sell all those stocks just in time for before the markets close. And that's essentially what day trading is. Because rather than doing fundamental analysis, you are doing technical analysis. And technical analysis is basically using the indicators like the MACD, the RSI, the moving averages on sophisticated platforms to help you make a better judgment and mitigate your losses. Because now you can paint this picture of where the price is going to move. You know, it is not foolproof, but this does cut your losses by a huge percentage. So you can use the price action and time your trade based on where the price is and the confluence of the indicators. And confluence is basically when the indicators are synchronized and they line up. And usually confluence can be at least two of the indicators lining up in your favor. Now, day trading is personality based. And what I mean by that is that if you're a very laid back person who is very anxious and gets stressed out a lot, and you have a job, a full-time job, so while the markets are open, you are working, then maybe day trading isn't for you. However, if you like the fast-paced environment, you love being in the heat of the moment, and you work well under pressure, and you don't have a job, rather you have an afternoon shift or a night shift, then maybe day trading is for you. But that's not the only requirements that you need. You also need to have good discipline and good focus. You need to accept that you won't always be profitable or have green days, and that you can lose a substantial amount of money on any given day. You are buying a stock and selling a stock within the day. But here's the thing, you can't oversleep and wake up at 12 and call yourself a day trader, because it's a whole different scenario for you. Most of the price action that occurs, for the most part, in the stock market happens as soon as the market opens up till around 11 a.m. That is when the bulk of the volume and the price movement happens with these stocks. After 12, after lunch, things start to die down. People are taking profits, and the stock price is becoming less and less volatile. Now, if you know exactly what you are doing when you're a day trader, you can become profitable. But don't fall into the get rich quick trap, which is where all these people who have Lamborghinis and big houses that cost $1 million telling you that I used day trading to buy all of this. No, they didn't. They used their courses that people are buying to buy all of that expensive stuff that they're using to flex on you. They're renting Lamborghinis, and they're making it look like they bought the Lambos or these other expensive sports cars and luxury vehicles. Again, I say, if you know what you're doing, you can be a very profitable day trading, because compound interest will work in your favor. Because let's say you have $30,000 to day trade and you make a 30% return. Now you have that amount, and then you make a 30% return on that amount, and then it just keeps on growing exponentially. And you can apply the same thing to dividend stocks, as long as if you reinvest the dividends, then you will gain compound returns because it will just keep on growing, growing, and growing. And that is called drip. That's real drip. Now, I mentioned this a few minutes ago. I used to be a day trader. That was like the second investing strategy that I took when I first started using Robinhood. And I did make some money, but then I lost a whole lot of money because of 3 bad trades. So again, I say, if you know what you're doing, you can become profitable. But do you know that 9 out of 10 day traders lose money? And they lose money for a number of reasons, because of bad money management, poor strategy, but also those aren't the only factors. You can just lose money just because things aren't working in your favor. One more important thing I should also disclose is that if you really want to be a professional day trader, you need at least $25,000 to day trade. And if you have less than $25,000 and you trade 4 times in a 5 business day rolling cycle, you'll be labeled as a pattern day trader, and your trading account can be restricted for up to 90 days. Now, there's a number of reasons why they implement all these rules, and this is because, the government doesn't know who you are, and you're taking all this money in a margin account, which I believe is borrowing money from the brokerage, and you're just trading. You might not know what you're doing. Then if you lose this money and you get a margin call, you have to owe the brokerage money. And if you can't pay it back, then it's over. So this is to deter anyone who either doesn't have a substantial amount of capital or people who are inexperienced from day trading. So that brings us to the next type of trading, swing trading. Swing trading is kind of like day trading, but instead of buying and selling intraday, you're buying a stock in one day and you can hold that stock for up to several days or weeks, and then you sell it when the stock price increases. Swing trading, you're also using indicators to help you make the right judgment. You use technical analysis. You can also use fundamental analysis when swing trading. And for the aspiring day trader who doesn't have $25,000 or is maybe new to the game, this is your next best bet. I did do swing trading for a little bit and I fared much better than I did day trading because it is less risky because you're not buying like 100 shares of DWT and having to sell it intraday. Rather, you're buying it, you're holding it for a short while, and then if it goes up, even by just a little bit, since you have a huge number of shares in that position, your profits, but also your losses, are multiplied. But if you're just beginning, I highly recommend that instead of starting with trading either of these 2 types of trading strategies, that you invest in ETFs, which are exchange traded funds. ETFs were invented by this guy maybe like a few decades ago, and it is basically a stock that has positions in hundreds or even thousands of stocks from the 3 main indices, the NASDAQ, the S&P 500, or the Dow Jones. And they track the movement for stocks in these different indices. And they have all these different categories: low volatility, high yield dividends, or ones that are dedicated for the 3 indices. And it is less risky because your position is spread out throughout all these stocks, and it is less time consuming because instead of doing research on dozens of stocks, you can just do your research on this ETF, and you don't have to listen to the earnings calls or keep yourself updated on the financial history because the ETF takes care of all of that. So I'm going to leave some in the description that I highly recommend that you can choose. They are growth ETFs, some are dividend ETFs, and some are low volatile, so they're even less risky. After you invest in the ETFs and you watch a whole bunch of videos and read up on Investopedia articles, then you can make the transition to looking at individual stocks. So we've taken a look at these 3 strategies. What is the verdict? Well, the verdict is that there is no wrong way to trade or invest. Like I said before when we were talking about day trading, it is personality based. It is based on what you think is best for you because you know yourself better than anyone else. Just because Warren Buffett is a dividend investor who invests in these big companies doesn't mean you have to necessarily follow in his footsteps. Just because people like Ricky Gutierrez are day traders doesn't mean you have to do day trading. Do what you think is best for you. Do your research on these different trading strategies and also create your own strategy for yourself. And it might take a while, and it's good to test the waters because it's a great learning experience. I learned a lot about myself by doing day trading, swing trading, now ending up with dividend investing. And it's up to you to find the one that is not only the most profitable for you, but the one that is best for you. So Warren Buffett makes money from long-term investing, but other people, professional day traders, make their money from day trading. By just trading or investing in stocks will not make you wealthy because that is only one income stream. All of these wealthy people, they don't even have to be millionaires, just people who are wealthy in general. Most of them have multiple streams of income. This can be real estate, Roth IRAs, a business that they've owned, like an e-commerce business, affiliate marketing, or even a YouTube channel by monetizing their content. Lots of these people have about 7 streams of income. If you want to be wealthy, you can't just have a job, whether it's part-time or full-time. That is why people take their income and invest it into the stock market, which now becomes an asset. Now, instead of having one stream of income, now they have 2, which means that they have a higher chance of becoming wealthy and financially free. It is up to your preference, your personality. Do you prefer the slow, gradual, and passive strategy? Then choose dividend investing. But do you like to get technical, enjoy the sophistication and mid to fast pace atmosphere? Do you like watching your portfolio grow and grow? Then invest in growth stocks, swing trade them, buy low and sell high. But you don't have to pick a side in this. You can combine multiple trading and investing strategies together. That is what a number of people do, and a number of people have done, such as Bruce Wang. Now, this is recommended for people to have a bigger portfolio because if you have less capital, then you might not be able to do this because you're more likely to have a smaller number of shares in a specific stock. So you might only have one share in one stock. So if you sell that, then you've lost your position. Now, this could not be greater of a coincidence because last week someone commented on my Robinhood tutorial video. And they commented and they also DM'd me on Instagram. And they asked, why did you stop trading in the stock market? I'm a dividend investor, but I'm just curious about the idea of trading stocks. Now, I already answered it for him, as you can see right here, and we had a little conversation, but I'll once again answer it for everyone. So I didn't really quit trading stocks to go solely on dividend investing because, as I said before, dividend investing is slow and gradual. I'm 18 years old. I'm still dependent on my parents. I don't have a mortgage to pay. I don't have insurance to pay. I don't have a car lease to pay off. So I'm able, if I were to lose all of my money right this second, it is not the end of the world for me. I'll just go get some more and then start again. I'm not going to curl up in a ball and cry about me losing my money. You got to get back up again. So people who are around the 18 to, I'm going to say 21-year-old age range, they are still in a way dependent on their parent or guardian. So now I have the chance to aggressively invest almost all of the money that I gain, whether it's from all of the income streams that I'm currently developing, so that it can grow as I grow in the future. Once I get to around 25 plus, that's going to be much more difficult. So with that being said, instead of only dividend investing, I'm still swing trading on the side. So I can buy. So you can do this in a number of ways. You can invest in growth stocks while also investing in dividend stocks. And I highly recommend you do this on separate brokerages so that you don't get confused. And you can swing trade the growth stocks while still holding your dividends for long-term capital gains and the dividend, of course. Hold these growth stocks, buy low and sell high. So currently, I created an M1 Finance account, and I'll do a video on that later. And I now have 10 stocks that are mostly growth stocks, but also other dividend stocks that are just higher priced. And the reason why I chose M1 Finance is because it has fractional shares, because Robinhood is taking way too long. So I just did it mainly because of that. But I have a fractional share in Tesla, Nvidia, JP Morgan, McDonald's. And to balance it all out, I invested in one ETF, which is VU. That's a very good growth ETF. But I still have my dividend portfolio on Robinhood. The other strategy is to invest in the dividend stocks to build your dividend portfolio. But if you're to buy 50 shares of Wells Fargo and the price goes up like $2, then you can sell 25 of those shares and take a profit. At least you're taking some profit without selling off your whole position. And you can do this. I recommend you do this after the ex-dividend date, which is the date where if you hold a position after that, you are locked in to get the dividend. If you sell your stocks before the ex-dividend date, you're not getting your dividend. So make sure you try to do that after the ex-dividend date. And yes, that's it, guys. So at the end of the day, just choose what works best for you, what suits your personality. And as time goes on, remember not to let FOMO get to you. And that is emotion, the fear of missing out or the fear of losing. If you are someone who, no matter how long you've been trading, you just can't bear to look at your portfolio fluctuate, then just don't look at your portfolio. Look at it maybe once or twice a week. If you're a dividend investor, and if you're a swing trader, set a stop loss. That's all you have to do. There, problem solved. Thank you so much for watching this video. I really hope you enjoyed it. I really did enjoy making this video for some reason, which is very odd. I don't say that. I mean, I enjoy making videos, period. But there's just something about this video. So if you guys enjoyed it as well, please do remember to leave a like rating for the YouTube algorithm. And leave a comment, any feedback. Let me know about your journey or what your strategy is in the comment section down below. If you're new to the channel, please do hit that subscribe button. We're almost at 100 subscribers, which is crazy because it's only been like a month of me uploading these types of videos. So thank you guys so much. Hopefully we can get to 1,000 one day very soon. I'm feeling like we can get to 1,000 before the end of 2020. Do you think we can do it? Subscribe and join this journey. I'll catch you guys later in the next video. Enjoy your day and happy trading.